Welcome to the IFRS for SMEs technical series. I am Calverwell and I help SMEs apply accounting standards to improve reporting, strengthen compliance, and build credibility with banks, investors, and partners. In this video, part of the Technical Accounting for SMEs series, we are looking at Section 22, Liabilities and Equity. We'll define financial instruments, liabilities, and equity. Then we'll look at classification rules, special cases like puttable instruments and convertible debt, and finally, how distributions and treasury shares are treated. A financial instrument is a contract that gives rise to a financial asset of one entity and a financial liability or equity instrument of another. A liability is a present obligation arising from past events that requires outflow of resources to settle. A financial liability includes contractual obligation to deliver cash or other financial assets, obligations to exchange financial instruments on unfavorable terms, or contracts settled in the entity's own equity instruments with variable terms. Equity is the residual interest in assets after deducting liabilities, investments by owners, plus retained profits, less losses, and distributions. Financial instruments are classified based on substance, not form. If the issuer has an unconditional right to avoid delivering cash or assets, the instrument is equity. Otherwise, it's a liability. Equity instruments include ordinary shares, but classification depends on terms and conditions. Normally, puttable instruments where holders can demand redemption for cash are liabilities. However, they can be treated as equity if holders share pro rata in net assets on liquidation, they are subordinate to all other claims, they have identical features within the class, there is no contractual obligation to deliver cash, and cash flows are based substantially on performance of the entity. An instrument is a liability if distribution on liquidation is capped, redemption is mandatory or at holder's option, or payments are required before liquidation. For example, preference shares that must be redeemed by cash or for cash are liabilities, not equity. When shares are issued, if cash is delayed, recognize the receivable offset to equity. If cash is advanced, credit equity to the extent received. If only subscribed with no resource received, no recognition occurs. Equity is measured at fair value of resources received, net of transaction costs. If payment is deferred, measure at present value. For compound instruments like convertible debt, allocate proceeds between liability and equity components. Liability equals fair value of similar debt without conversion. Residual equals equity. The liability is measured using the effective interest method. At conversion, the liability is de-recognized and equity is recognized for the converted shares. When liabilities are extinguished through equity issuance, if fair value of equity can be measured reliably, use that as the measurement basis. If not, use fair value of the liability. The difference between carrying amounts of liability and equity issued is recognized in profit or loss. When an entity reacquires its own shares, These are treasury shares. They are deducted from equity at cost. No gain or loss is recognized in profit or loss on purchase, sale, issue, or cancellation. Treasury shares are never recognized as financial assets. Dividends and other distributions reduce equity. A liability is recognized when dividends are declared or approved. For non-cash distributions, measure at fair value of assets to be distributed, adjust carrying amount of dividend payable up to settlement date. Differences between carrying amounts of assets distributed and dividend payable are recognized in profit or loss. Changes in parent's interest in a subsidiary that does not result in loss of control are treated as equity transactions. No gain or loss is recognized in profit or loss. Instead, adjustments are made directly in equity. Section 22 provides SMEs with clear rules for distinguishing liabilities from equity, ensuring transparency in financial instruments and consistency in how shares, dividends, and treasury stock are treated. Stay tuned for the next part of the Technical Accounting series, where we'll explore another important section of the standard dealing with provisions and contingencies.